Chapter 7, Cash and Receivables. This is part 1. I'm going to go through how to do a bank reconciliation. So, how is cash reported on a balance sheet? Well, cash is the first asset listed because it's the most liquid. Businesses often have several accounts, but they customarily combine all cash amounts into a single total. Now, yes, okay. On the balance sheet, this total may be called cash, or it may be called cash and cash equivalents. Cash on the balance sheet includes coin, currency, check on hand, petty cash, checking accounts, money orders, and traveler's checks. Cash equivalents include very liquid, very safe, short-term investments. Usually the rule is to have a maturity value of 3 months or less. Now the bank reconciliation. Bank reconciliation is a document that identifies and explains the differences between a depositor's record of a cash account and a bank record of the same account. On a monthly basis, a company will receive a bank statement from its bank that shows the bank balance, the cash balance in the company's account according to the bank. Now what you have to remember is the bank does not normally close at the last day of the month, but the books do, so you're always going to have a discrepancy. This balance usually does not agree with the book, the cash balances according to the company's records. So, what are the differences? For the bank side, normally you'll have deposits in transit. These are deposits that are made by a company but have not been recorded by the bank. And usually this is end of month type activity, where the bank cuts off before the books do, so the bank may cut off on the 28th. The books cut off on the 31st, so you'll have deposits that were made but will not be reflected in the bank statement. Then you have outstanding checks. These are checks that have been issued by a company, but they have not yet been cleared by the bank. And then, of course, you have bank errors. Now, any adjustments for the bank in the reconciliation are not journalized. If there are bank errors, then you just call up the bank and get them corrected. Now then we have the book side. The book side, what you could have here is bank collections, where somebody transfers money directly into your account that you didn't record. You could have electronic fund transfers from your account to somebody else's, or from somebody else's to yours. You could have earned some interest revenue. You could have non-sufficient fund checks, checks that are not good. You will have service charges, and then you can have errors where you book something incorrectly. Now let's take a look at how we do a bank reconciliation. So here we are, Company A. We have the company checking account, and then we have the September bank statement. And if you notice, the ending balance is not the same, which means we need to do a bank reconciliation. So we always start with the bank first. So the first thing we're going to do is to check to see, are there any deposits that have been recorded by the bank to determine, actually by the book, that to determine if there are any deposits in transit. So that deposit was recorded by the bank, but this last day sales was not. So we have a reconciling item for the bank of $420. Now we're going to see about checks to see, are there any that we've issued that haven't cleared the bank. So this one has cleared. We have another one that cleared. We have another one that cleared, but the amount is different. And it turns out that the bank is correctly, but we booked it incorrectly. So we have to make an adjustment on our books for $9. Then we have another check that cleared, and it turns out we have 2 checks that have not cleared, number 926 and 927. So those will have to be adjusting entries for the bank. So now let's look at the bank reconciliation and figure out what the adjusted bank is. So we start with the bank balance, and that's always from the bank statement. We add in our deposit in transit, and then we subtract out our checks that have not cleared. And this is the adjusted bank balance, which is exactly what our books have to equal when we go through and do that. So now let's go back to the 2. Now we're going to check to see are any deposits made by the bank that have not been recorded, any errors on the part of the company, or any charges by the bank. And of course we have one error that we made, and we have these $25 and $14 charges. So we have to adjust for the check error and the bank charges to record on the books. So we start with our balance per books. We have nothing to add in because we didn't have any deposits made that we didn't record. We have to make the correction of the check. We have to record the printed checks and the service charge. And so now we equal, and we have reconciled our bank account. But we still need to, any adjustments that you see on the book side, we have to do journal entries for it. So in summary, how do we treat reconciling items? Remember, on the bank side, we always add deposits in transit, subtract outstanding checks, and add or subtract errors by the bank, if it's the bank's fault. On the book side, we add bank collections, interest revenue, and electronic fund transfers in. We subtract out non-sufficient checks, the cost of printing service charges, and electronic funds transferred out, and then we add or subtract any corrections of errors. Now let's look at our journal entries. Journal entries must be made and posted to the general ledger so the cash account reflects the updated cash balance. All items on the book side of the bank reconciliation, as I said, require journal entries, whereas none of the items on the bank side require journal entries. So first we're going to record the error, and then we're going to record the bank charges. Now you could have done those as 2 separate entries. I did it one, but I think in the homework they want you to do 2. And that concludes this part 1.